odds are, here's a little trick too. Delta is the rate at which it changes compared to the stock price. A little cheat sheet. It's not exact, but this. So this is that 380 was a what is it? A 3 delta. That means there's 3% chance that this 380 is going to be in the money. So you have 97% odds of it not being in the money. So that's kind of a little cheat sheet also. That's at this date and time. As soon as Apple moves a little bit, this will move. So everything is at this date and time. So that's just to show you how that's an extreme scenario of, I highly doubt you're going to be getting called away. Odds are you're going to take in 34 cents and life is good, and you'll probably get to bring it down a few times. If you really don't want to do that, then you can do all these. If you want a little bit longer time frame, come out to these Octobers and sell the again, your vision's going to be a little cloudy coming out this far, and if your goal is you do not want to get rid of the shares, I would go with that front month, because you don't know what's going to happen out here. They could have just monster earnings above and beyond what, they already are having, or a share buyback program comes out, something like that. So if you come out this far, be prepared to, unless you come way out, be prepared for them to have good chances of getting called away. I'm just speaking on a fundamental basis, just because, I've tracked Apple so closely. It just has so much earnings power. But you can come out to this 450 and just lock that in, or maybe more realistic, if you're scared about the economy, a double dip and all this stuff, come and just sell the 400 Octobers and take in $300 per 100 shares, or equivalent of. And if Apple if Apple slides down to 300, whatever, these will, go to $1.50. Go ahead and close them up, take your gain, repeat the process. If you're happy with what's tough about explaining these specific situations, everyone's so different with, retirement time, not how much risk, people want to take a lot of risk, but there's nothing wrong too with coming out to January 13 if you want to sell on these against your stock, because you plan on holding it that long, and come and sell the 500 calls for taking $1,000 per 100 shares, and just say, and then if Apple goes down to 320 and these move to $8, buy them back, take your $2, and life is good. If Apple just, from that point you sold them and you have horrible luck and it just keeps running and running, well, you get rid of Apple. All that work, when you bought it at $80 share, whatever, you're getting rid of it for 500 plus 10, so 510. That's not so bad. So just if people do go out and you have no intention of getting rid of your shares, it can't really help you on that. Just go out pretty far. If you're looking for protection, stuff like that, that's a different story. Then you can, sell any of those you want. This is going to be more on the people that would really like to keep their shares, and that didn't know what to do with this data. For that type of investor, yeah, don't use it. Really quick, I just thought of, for people that maybe have gotten in and out, are more investors than traders day to day, say, or short term, a good strategy, if the market's right, to do is, say you just accumulated Apple at this 330 price. So these are July's again, and you own Apple at 330, and you're just looking for a little gain. So sell these 330 at the monies and take in $10, take in $1,000 per 100 shares. And if Apple closes above 330, well, you get called away at 330, but you took in $10, so you really sold Apple for 340. And then you can come to this 335. You can take in a $5 gain, plus, if Apple gets to 335 plus this 775. The thing is, if Apple never gets to these, that's what just the risk will change. Um, so you can do it that way. It's a great strat. Like, I have a buddy that's been doing this for a long time. He'll just buy Apple do it on the weeklies, but let's say the monthlies. Buy Apple every single month. So he bought it for 330 and then sell that at the money and take in, or you can even come down to go sell this 325. We'll stick to this though, and takes in $10. So he took in $10, locked in this month. Of course, he risks Apple going down, but we all do. He has a $10 cushion, so really his cost basis is $320 because of this $10. If Apple goes above 330, he gets his shares taken away, but he collected 10, so he's really sold Apple at 340. And what's great about that strategy is for times like just happened right now, the last 6 months or whatever, Apple's just flatline has gone nothing but sideways to down basically. And so he's looking like a genius. And I'm of the type that's like, no. Earnings is coming. Worldwide developers coming. No. You're okay. You're going to be. And what's good about selling covered calls is you're going to be sorry that you made less money. There's no, you're going to be sorry that you lost money. That doesn't exist with covered calls, except your normal underlying position that always has the risk. I'm talking about the covered call part never has any risk ever associated with it. So I've always been coming out here. No, I'm selling these 370s. It's going up there. You just watch this. P ratio is going to be between 18 and 20. It's going to have to. Well, who's the smart guy now? Him that's just doing this simple buy it and sell the right at the money and get rid of the stock. And I'm the dope. But what happens too is we've all seen Apple goes on massive runs, and when that's the case, who's the genius here that just took a $50 gain when he took a 10. So that's all going to be hindsight stuff, but just let you know there are strategies out there like that. Like you can allocate majority of stuff like super bullish on Apple. I'm going to sell these and Apple's going to get there. I know it. If I'm wrong, just keep rolling it down. No harm, no foul. You never took a loss. And then you can get one leap, buy it now or 100 shares and sell taking this $10 and try that strategy or try all this stuff on paper. There's just endless possibilities with options. So that's really what I wanted to get at. I think people are getting confused on, I'm a long-term investor. He says it's not going above 350, but I think it's going to be 400. Why would I use this? This is more just for trader stuff. If you're just a true investor, we all know that these can be wiped out in a heartbeat. I'm just saying past history, this is highly probable. What about that 17% time it didn't happen? So it's always nice when that 17% does happen to be over here. Much easier to sell here, go down to where Apple is. You be in control, skate to where Apple is instead of you being here crossing your fingers. Apple goes here and you're like, again, you didn't lose any money, but it also hurts just as bad to see Apple here. You put all that time and effort into it and you got stopped out there for the most part. So hopefully that answered some questions on, this is more for traders. Covered call investors, come out to whatever you truly feel. And if you're wrong, no harm, no foul, roll it down. 25 cents is better than the guy that sat there and did nothing. So these are great strategies for people that you can just check on Apple once a day, once a week, whatever. If you sold these, if you own Apple, you bought it at $200 and sold these 365s for $1. You went on vacation and Apple's at 400. So your broker sold your Apple at 365 plus you kept that $1. You sold Apple at 366. Big deal. You didn't make as much money. There's nothing to lose here. And so hopefully, let me know what you guys think.